quickly, and with with small inventory, they can reprice their product daily if they need to in hyperinflationary settings. The reason I say all this is those are all characteristics which do not exist in the traditional investment world. And so right now, when you've got the market tanking, you've got consumer confidence at an all-time low, you have the big three automakers and everything else that seems to be relatively crumbling, they are all correlated and have factors to their business models which do not exist at the micro-entrepreneurial level, which is why microfinance continues to be a strong and growing field in this economy, and with lots of capital still flowing in. So microfinance, as you all know, is provided by little micro banks called microfinance institutions. There are probably 5,000 to 8,000 microfinance institutions around the world. We're generally broken into 4 tiers. No one really talks about the 4th tier, which is the largest, but it has the most untried, lowest, least stable and sustainable organizations at that level, and then going up to the top tier organizations. The sort of top tier microfinance institution would have a structure that generally follows something along these lines. Probably the most important, I guess each is an important thing. First of all, starting with the bottom line, is these are profitable organizations that typically they're earning return on assets that is more than twice what you would see in any sort of commercial financial institution in the United States. It would make 1 to 2% ROA would be solid return on assets. These institutions also have operating costs, however, that are about 2 or 3 times higher than a typical financial institution because of the intensity of having to collect on these micro loans to these micro entrepreneurs. It's a very labor intensive product and service to provide. And as the Grameen model set out to prove with Professor Muhammad Yunus in Bangladesh 30 years ago, the loan losses and the sort of the credit quality of the micro entrepreneurs is far better than what commercial credit card companies incur here, and far less than what traditional banks had perceived the working poor to be. With loan losses of write-offs even less than 1%, loan losses sort of reserves are 2%. That sort of is across the board for the whole industry, and that is very low. And the reason why the industry is growing, because it's, again, it's an instrument of respect and dignity to the person, to the working poor. And Muhammad Yunus determined, and I have seen, that all human beings have a sense in them of duty and respect, and so if someone is lending to them, they're not just going to skip out on it. And they're human beings like all of us. Shock. That's too detailed. The industry is growing really rapidly, all the key areas. And so what we are, as I sort of mentioned before, we're an intermediary to the industry in between the investors and the microfinance institutions, wherever they may be. It's the same thing. The market's determined, overall the market is determined to be about $300 billion industry. Essentially today, about 1 in 10 entrepreneurs is being serviced with a loan. So there is a massive unmet demand for microfinancing, and we will obviously hope to see that gap closing over the next several years. So this is a carryover slide from the Duke presentation, so I'm thinking evolution here. This generally microfinance funding has evolved from more of a traditional economic development approach, which was more donation-based, to a more commercial investment fund base. What these stand for, donors, IFIs are government institutions like the World Bank. SIFs were a niche, it's called a social investment fund. So it is a subsidized funds that they began being developed in the late 80s. But these were sort of subsidized funds that had investors that were interested in making an impact, but were not seeking out commercial returns. And then MIVs are microfinance investment vehicles. That is what MicroInvest is. So we are a private equity firm, boutique firm with 15 employees, and we manage investments in microfinance institutions, as I mentioned. The funding is definitely increasing, which is the main sort of illustrative point of this slide, what we are. To our mission, as I was touching on sort of the traditional end of economic development, there's two broad schools. Traditional economic development focused on the bottom billion of the economic pyramid. So the base of the economic pyramid, it's generally felt that there are 4 billion people living on $2 a day or less. The people, the extreme poor, that are living on less than $1 a day is roughly 1 billion people. And so that whole combined base of the pyramid is, as it's called, is 4 billion people. Traditional approaches focused on the poorest of the poor, and still do, and look at the poorest billion as a population that, through their situation, through their environment, are generally incapable of helping themselves out of their situations. On the other end, sort of economic development, is a more market-oriented or market-driven approach to economic development. That is targeting the bottom 4 billion people and targeting them as producers and customers, and as individuals that, if given the right tools, can help themselves out of poverty and improve their situation. Generally, so with those two ends, MicroInvest was founded on the premise that the best way to reach the 4 billion people and the need for capital to get to them would be to do microfinance on a commercial basis. That is, if we sought out working with microfinance institutions who were engaging their customers commercially and they were running themselves and their operation commercially, and we could get a commercial return on our investment in them, and likewise return a commercial investment to investors, and that to really bring the capital that needs to be brought to bear to address this issue of 4 billion people, that